Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now it was another blow-hot, blow-cold week in the Middle East with Trump, of course, pushing for renewed strikes and then, of course, following up with talk of a deal. This flip-flop, of course, hitting markets on consecutive days. And these events themselves following what was a strong US jobs report late last week and an ECB rate hike more in recent days. Now, against this sort of eventful list, do investors need to consider adapting portfolios to these latest events? To discuss that, I'm joined today by Rajat Bhattacharya, who's a senior investment strategist at the CIO office. Welcome, Rajat. So today we have fairly hawkish market expectations for the Fed policy rate that followed, of course, the solid US jobs report. In your view, when you combine that with recent news flow on Middle East clashes, where do you think markets go from here?
Right, Manpreet. Glad to be here. As you mentioned, this is a flip flop. Now, last week we did flag extremely stretched investor positioning following a 2-month rally in the AI-related equity sectors as a near-term risk for equities. Now, we cited US monthly jobs and inflation reports and major upcoming IPOs, besides the Middle East uncertainties, as potential catalysts for a pullback in risk assets. Now, as it turned out, a hawkish repricing of Fed rate expectations following a solid US payrolls report and renewed Middle East hostilities acted as catalysts for the equity market pullback that you mentioned there this week. Now, after all of that, we remain cautious near term, even with after the pullback, because bullish US equity positioning still remains elevated despite the recent reversal. Now, as a result, we would continue to avoid concentration in our portfolios, preferring the equal weighted developed market equity index in the near term and diversify within the tech sector across semiconductors, hardware, internet, and software. Meanwhile, what we're doing is pushing back our Fed rate cut expectations to next year and tactically shortening dollar bond duration to 3 to 5 years. We can unpack that a bit more later, but what we also believe is that there is this recent pullback in gold is an opportunity really for long-term investors to add exposure.
Thanks, Rajat. Indeed, a lot to unpack there. But let's start with investor positioning and dig into a bit more detail there. So where does investor positioning stand at the moment?
Yeah, even after this week's pullback, actually, US equity investor positioning remains high, and that's around 1.13 standard deviation when I last checked today, above its long-term average. And this is down from 2 a week ago. But history shows that the S&P 500 index has typically bottomed only when positioning has fallen back to around neutral levels, and by that we mean around minus 0.5 to plus 0.5. So we're almost halfway down in terms of the positioning unwind, and another half is still to go. Meanwhile, our fear and greed indicator that we track has normalized after surging close to extreme greed levels in May, which is a good sign, but the put call ratio component remains in greed territory. So again, there is some marker there that we still need to go through before this settles. We would continue to reduce concentrations given these environment in equities and take advantage of the elevated volatility through structured strategies.
All right, so that's a good perspective on equity positioning. But what about bonds, particularly the point you made about duration? How should investors be thinking about bond allocations?
Yeah, the bottom line is that we are tactically shortening dollar bond duration. Now, Middle East uncertainties, despite President Trump's latest comment signaling an imminent deal, could delay the normalization of shipping through the Hormuz Strait during peak summer demand season. Now, this would leave oil prices potentially elevated for longer. Meanwhile, the US job market has picked up over the last 3 months, and this is, all this is actually evolving into a backdrop which is likely to embolden the hawkish members of the Fed when they meet next week. Mind you, the new Fed chair, Warsh, that's his first meeting next week, and that would mean that they drop any reference to any rate cuts from their post meeting statement next week. Now, as a result, we now expect the Fed to hold rates for the rest of the year. Given all of this, we are tactically shortening bond duration, focusing on the 3 to 5 year maturities at this point in time.
All right. So I think that's clear that you expect the Fed to hold rates for the rest of this year. But looking a little beyond that, are you still expecting the Fed to head in the direction of eventually cutting rates or a hike?
Yes, we are actually. Markets are. I know markets are expecting rate hikes. In fact, one hike this by end of this year. We still expect the Fed to actually eventually cut rates, but we all we're doing is pushing back our Fed rate cut expectations to next year. Now, the U.S. inflation report for May showed that gasoline prices are primarily driving the latest acceleration in headline inflation to a 3 year high. However, if you look underneath that, there's been limited pass through to underlying inflation, what we call core inflation so far. Meanwhile, the wage pressures are continuing to ease. Now, this leads us to believe that if oil remains below, let's say, $120 a barrel, the oil price driven headline inflation is likely to peak sometime in this quarter before subsiding gradually over the next 12 months. Such a trajectory in inflation should then allow the Fed to cut rates by the middle of next year, in our view, especially if the ongoing oil shock hurts US growth with a lag.
Thanks, Rajat. And maybe moving across to the ECB, we've got a rate hike. Should we be expecting more? And is there a trade to be done for the euro?
Yeah, so in the ECB, what they've done is unanimously raised their deposit rate by 25 basis points to 2.25%. But this move was widely anticipated. Markets had already priced that in. Now, President Lagarde highlighted growing concerns over energy driven inflation, but she did not commit to any future hikes. Mind you, the markets are pricing another 2 to 3 rate hikes. She did not commit to any future hikes, in fact, stating that decisions will be made on a meeting by meeting basis. Now, the ECB raised its inflation forecast with the 2% target not expected until 2028. At the same time, it cut its growth estimates for both 2026 and 2027. As economic data weakens and wage growth lags behind inflation, we expect the ECB to actually pause for the rest of the year. In fact, our base case expects the June move to be the final hike of the cycle, barring, of course, major shocks in energy markets. Now, to your point about what does euro dollar do, the euro is likely to trade within a range, within the 1.14 to 1.1640 range, I should say, but with a bearish bias in the near term, with the risks skewed to the downside, given the point about the Fed rate expectations are excessively hawkish. Now, despite this weakening macro picture, as I mentioned, that the ECB policy path and the market expectations are way too hawkish. They're expecting 2 more rate hikes by 2027. Now we see this positioning as excessively hawkish, and given that ECB President Lagarde has warned inflation triggered by Middle East conflict is widening beyond energy, but refusing to commit to further rate hikes, we do see that there is scope for the euro dollar to probably have a bearish bias within the range bound trading that we expect in the near term.
All right, and finally, and very quickly, gold is Nasta stands out to the extent it's pulled back significantly. Do you expect more downside there?
Yes, so gold has broken below its 200-day moving average, which is a key technical support level that had held since October 2023. It is now testing the next major support zone, which is just around or below 4100. Now, there is a chance that it goes further down because the momentum, a downside momentum, is pretty strong. But we see the latest weakness as an opportunity for long-term structural investors who are under allocated to the precious metal. Our constructive view is based on sustained central bank buying, which remains intact, as seen from China's sustained purchases in recent months, as well as due to the gold's traditional role as a portfolio diversifier. Now, gold has outperformed other major assets also during times of stagflation. So, if stagflation is a big risk scenario that you want to hedge against, this is a good time to add exposure to gold.
Okay. Well, I think that brings us to the end of the time we have available today. So we'll end the conversation there. Thanks, Rajat, for taking the time to speak to our listeners. And if I can maybe just end with the top three takeaways from today's conversation. Number one, I think in equities, a lot of discussion around positioning, but today we prefer to broaden exposure, and particularly like the equal weighted developed market equity index. Second, from a bond market perspective, given our updated views on the Fed, we would tactically shorten bond duration in US dollar portfolios to 3 to 5 years. And finally, gold, of course, facing some near-term downward pressure, but we do see key support in the region of $4,100. So thanks very much for joining us in the conversation today. We hope you enjoyed the podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.